When most people think about debt, they focus only on the monthly payment. They believe that as long as they can afford the payment, everything is under control. But that's one of the biggest financial mistakes anyone can make. In this video, you'll learn how to pay off debt fast, whether it's a business loan, vehicle loan, or credit card debt. Number 1. Stop borrowing today. The fastest way to eliminate debt is to stop adding new debt. It sounds obvious, but many people continue using their credit cards while trying to pay them off. Others refinance a vehicle, take another business loan, or finance equipment they don't truly need. As a result, the debt balance never stops growing. Imagine a business owner who owes $40,000 on a business loan and another $8,000 on a credit card. Every month, he pays $1,500 toward his debt. That sounds responsible until he charges another $1,000 on the credit card every month for expenses that could have been reduced or delayed. Instead of moving forward, he is running on a treadmill. Before making another purchase, ask yourself one simple question. Will this expense generate enough additional income to justify borrowing money today? If the answer is no, wait. Delaying a purchase for a few months is almost always cheaper than paying years of interest. For business owners, prioritize purchases that directly increase revenue or reduce operating costs. Fancy office furniture, expensive electronics, or unnecessary subscriptions rarely produce enough value to justify financing them. For personal finances, avoid financing lifestyle upgrades that lose value quickly. The moment you stop creating new debt, every payment you make begins reducing your existing balance instead of chasing a moving target. That single decision creates momentum. Paying off debt becomes measurable, motivating, and much more achievable because every dollar now moves you closer to financial freedom instead of keeping you stuck in the same cycle. Number 2. Know every dollar you owe. Many people cannot pay off debt quickly because they don't have a complete picture of what they actually owe. They know they have a vehicle loan, a business loan, and perhaps a few credit cards, but they don't know the exact balances, interest rates, monthly payments, or payoff dates. Managing debt without this information is like trying to complete a road trip without a map. Start by creating one simple debt list. Include the lender, current balance, interest rate, minimum monthly payment, remaining loan term, and total monthly payment. Seeing everything in one place often reveals surprising opportunities. You may discover that one credit card charges 24% interest, while another charges only 12%. Or perhaps a vehicle loan has only 12 payments remaining, making it an excellent candidate for early payoff. Imagine someone paying $600 toward a business loan, $400 toward a vehicle loan, and $300 across multiple credit cards every month. Without organizing this information, they simply make payments automatically. After listing every debt, they realize the credit card interest alone costs more than the vehicle loan. That insight completely changes the repayment strategy. Business owners should also separate personal debt from business debt. Mixing the two often creates confusion and makes it difficult to measure business performance accurately. Knowledge creates control. Once every debt is clearly documented, you can build a repayment strategy based on facts instead of assumptions. Financial clarity is often the first major step toward becoming debt-free much sooner than expected. Number 3. Attack one debt first. One of the biggest mistakes people make is spreading extra money across every loan at the same time. While it feels productive, it usually slows progress because no individual debt disappears quickly. Instead, focus all extra payments on one target while continuing to make minimum payments on every other loan. Suppose you have a business loan with a balance of $35,000, a vehicle loan with $10,000 remaining, and a credit card with $5,000 outstanding. After paying all minimum payments, you have an additional $500 available every month. Rather than dividing that $500 between all three debts, apply the entire amount to one loan. Many financial experts recommend eliminating the highest interest debt first because it saves the most money over time. Others prefer paying off the smallest balance first because it creates motivation through quick wins. Either approach works far better than dividing extra payments everywhere. Imagine paying off a $5,000 credit card completely. Suddenly, that monthly payment disappears. Instead of spending the extra cash, redirect the entire amount toward the next debt. As each balance disappears, your available cash grows larger and larger, accelerating every future payoff. Business owners can apply the same principle to equipment loans, inventory financing, or working capital loans. Eliminating one financial obligation at a time simplifies cash flow management and reduces financial stress. Momentum is powerful. Every loan you eliminate permanently increases your monthly financial flexibility and brings you one major step closer to complete financial freedom. Number 4. Cut payments that don't matter. Many people search for ways to earn more money before looking at where their existing money disappears. Yet reducing unnecessary expenses often produces immediate results without requiring a second job or additional business. Review every recurring payment over the last 3 months. Look for subscriptions, software, memberships, streaming services, premium apps, dining expenses, impulse purchases, and convenience fees. Small monthly expenses rarely seem significant individually, but together they can easily total several $100s every month. Imagine a business owner spending $200 on unused software, $150 on rarely used subscriptions, $200 on unnecessary office services, and another $300 on convenience purchases. That's over $800 each month. Redirecting that money toward debt could eliminate nearly $10,000 of debt payments in a single year before considering interest savings. The same principle applies to personal finances. Preparing meals at home more often, delaying non-essential shopping, reducing entertainment expenses, and negotiating insurance premiums can create hundreds of extra dollars every month. Those savings become powerful when applied consistently toward debt reduction. The key is not to eliminate everything you enjoy. Instead, remove expenses that provide little value while protecting the purchases that genuinely improve your life or business. Every unnecessary dollar spent today is a dollar that continues generating interest tomorrow. Every unnecessary dollar redirected toward debt shortens your repayment timeline and increases your future financial freedom. Small changes repeated every month often produce results that feel surprisingly large after just 1 year. Number 5. Turn assets into debt payments. Many people believe the only way to pay off debt faster is to earn more money. While increasing income certainly helps, another powerful strategy is to unlock cash that's already sitting around unused. Most households and businesses own assets that provide little or no financial value. These assets quietly take up space while expensive debt continues accumulating interest every month. Start by looking at everything you own with fresh eyes. For individuals, this could include unused electronics, old smartphones, extra furniture, recreational equipment, collectibles, or even a second vehicle that rarely leaves the driveway. For business owners, it may include outdated machinery, excess inventory, unused office equipment, storage units full of old supplies, or company vehicles that are no longer essential. Selling these assets may not completely eliminate your debt, but every dollar received immediately reduces future interest costs. Imagine a business owner who sells $10,000 worth of unused inventory that has been collecting dust for over a year. Instead of allowing those products to continue occupying warehouse space, he applies the entire amount toward a high-interest business loan. Not only does the loan balance decrease instantly, but monthly interest charges also fall. The business now has lower debt, improved cash flow, and more warehouse space for products that actually generate revenue. The same thinking applies to personal finances. Many families have thousands of dollars sitting in garages, closets, and storage rooms without realizing it. Selling those items and using the proceeds to reduce debt often provides a better financial return than keeping them. Assets should either produce income or reduce expenses. If they accomplish neither, consider converting them into cash that moves you closer to becoming debt-free. Number 6. Increase income with a purpose. When people earn extra money, they often celebrate by spending more. A bonus becomes a vacation. Overtime pay becomes shopping. A profitable business month becomes an excuse to upgrade equipment that still works perfectly. This behavior prevents financial progress because income increases while debt remains almost unchanged. Instead, give every additional dollar a specific job before you receive it. Decide in advance that bonuses, tax refunds, freelance income, commissions, side business profits, seasonal sales, or unexpected cash will go directly toward debt repayment. Imagine someone receives a $5,000 annual bonus. Rather than allowing that money to disappear across dozens of small purchases, they immediately apply it toward a credit card, charging 22% interest. That single decision saves future interest, reduces monthly payments, and shortens the repayment period significantly. Business owners can apply the same principle during profitable months. Suppose a company normally generates $20,000 in monthly profit, but earns $28,000 during its busiest season. Instead of increasing business spending immediately, allocate part of the additional profit toward reducing outstanding business loans. Lower debt creates stronger cash flow during slower months and improves long-term financial stability. Increasing income becomes truly powerful only when it changes your financial position rather than your lifestyle. Every extra dollar directed toward debt reduces future interest expenses, increases financial flexibility, and creates opportunities that would otherwise remain out of reach. The goal isn't simply to earn more money. The goal is to keep more of what you earn by eliminating the debt that continuously drains your cash every single month. Number 7. Negotiate better loan terms. Many borrowers assume loan agreements cannot be changed after they're signed. In reality, lenders often prefer adjusting loan terms rather than risking missed payments or defaults. If your financial situation has improved, your credit score has increased, or interest rates have fallen since you originally borrowed the money, it may be worth negotiating. Start by reviewing every loan you currently have. Compare your interest rates with what lenders are offering today. Contact your bank or lender and ask whether they can reduce your interest rate. Remove unnecessary fees, refinance the balance, or modify the repayment schedule. The worst outcome is simply hearing no. The best outcome could save thousands of dollars over the life of the loan. Imagine a business owner carrying a $100,000 business loan at 11% interest. After 2 years of consistent payments and stronger financial performance, the lender agrees to refinance the remaining balance at 8%. That 3% difference may reduce monthly interest costs dramatically while improving cash flow. That can be redirected toward paying off the loan even faster. Credit card companies may also lower interest rates for customers with strong payment histories. Even a small reduction can make a noticeable difference over time. Negotiating isn't about avoiding responsibility. It's about managing debt intelligently. Better loan terms allow more of each monthly payment to reduce the principal balance instead of disappearing into interest charges, helping you reach financial freedom sooner. Number 8. Automate your debt plan. One of the biggest reasons people fall behind on debt isn't a lack of income, it's inconsistency. Life gets busy, payments are forgotten, extra money gets spent elsewhere, and financial goals slowly disappear. Automation removes emotion from the process and keeps your debt reduction strategy moving every month. Set up automatic minimum payments for every loan to avoid late fees, missed payments, and unnecessary damage to your credit history. Then create a separate automatic transfer that sends additional money toward your priority debt immediately after each paycheck or business income deposit arrives. For example, suppose your paycheck arrives on the 1st and 15th of every month. Schedule an automatic transfer of $300 toward your highest priority debt on those same dates. Because the payment happens automatically, you're far less likely to spend that money elsewhere. Business owners can automate weekly or monthly debt payments directly from business operating accounts. This creates financial discipline and ensures debt reduction becomes part of the normal cash flow process instead of an occasional decision made only when extra money happens to be available. Review your progress every month. Watching balances decline provides motivation and helps identify opportunities to increase payments whenever income grows or expenses decrease. Successful debt repayment is rarely about making one huge payment. It's usually the result of hundreds of consistent decisions made over time. Automation makes those decisions easier, protects you from costly mistakes, and keeps your financial plan moving forward even when life becomes busy. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.